Hi everyone. Before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2025 May-June, Paper 3-1 and Paper 3-3, question number 2. This is the structured paper 3, which consists of 3 questions. Each of them will be of 25 marks, and the total time limit for the paper is 1 hour and 30 minutes. So ideally, you should be spending around 30 minutes in order to solve each question. And in this video as well, we'll be attempting to solve this question number 2 under 30 minutes. So without any further delay, let's get started. The equity of TNPLC at 1st January 2024 was as follows. We have the ordinary share capital, and in this case, the par value is 2. We have our share premium as well as the retained earnings. The following information relating to the year ended 31st December 2024 is available. On 15 March, a final dividend for 2023 of 0.35 per share was paid. Let's figure out the number of ordinary shares at the opening date. In order to figure out the number of ordinary shares, you just need to divide the total value of the ordinary share by the par value. So in this case, that will be 400,000 divided by 2, which results in 200,000. Now, the final dividend will just be 0.35 times 200,000. So 200,000 times 0.35, which results in the value of 70,000. Then the ordinary share capital has remained constant for the previous 3 years. So in the last 3 years, there was no issue of ordinary shares. On 16 March, a bonus issue of ordinary shares was made on the basis of 1 ordinary share for every 10 shares held. It is company policy to keep its reserves in the most flexible form. Okay, so we're trying to give out 1 new bonus share for every 10 ordinary shares that we have. And at the opening date, we know that we had a total of 200,000 ordinary shares. So for 200,000 ordinary shares, we'll have to give out 1 by 10 times 200,000 bonus shares, which results in 20,000 bonus shares. And we know that the par value is 2. Always remember that for the bonus shares, we only issue it at par value because in this case, we will be utilizing our reserves in order to fund the bonus issue of shares. So the total value will be 20,000 times 2, which results in 40,000. Now we have to utilize our reserve. The very first reserve that we utilize will be our share premium. If we take a look above, we can see that we only have 23,000 in our share premium. So we take 23,000 from the share premium, and the remaining value, we will take it from our retained earnings. So the remaining value is 40,000 minus 23,000, which results in 17,000. Okay. Then TNPLC issued a 6% debenture, which is to be repaid in the year 2028 of 300,000 on 1st January 2022. And our current year is 2024, which means that we utilize this debenture of 300,000 for the entire 12 months in the year 2024. This, I think we need to figure out our finance cost. So the finance cost for this debenture is 6% times 300,000 because we used it for the entire year. Then the company issued another 6% debenture, which is to be repaid in the year 2030 of 400,000 on 1st April 2024. This is our current year. And in our current year, we used it for the months of April, May, June, July, August, September, October, November, and December, which is 9 months. So we only need to figure out the interest on 9 months for this amount of 400,000. So that will be 6% times 400,000 times 9 by 12. So the total finance cost will result in 36,000. Then on 1st May, an interim dividend of 0.16 per share was paid on all shares in issue on that date. Remember that we made issue of bonus shares in March. So within May, we need to include the bonus shares as well in order to calculate the interim dividend. So the interim dividend will just be the rate per share, 0.16, times the number of shares. Initially, we had a total of 200,000 ordinary shares. Then we issued 20,000 bonus shares. So we have a total of 220,000 shares. So the interim dividend will just be 35,200. Then profit for the year amounted to 180,400. Alright, let's take a look at our first question. We need to prepare the statement of changes in equity for the year ended 31st December 2024, and a total column is required. Okay, we have the total and we only have three other columns. We have our retained earnings, we have the share premium and the ordinary share. Let's write it down. So we have the retained earnings, we have the share premium, and we have our ordinary shares. Okay, so we can start with the opening balance, which is the balance at 1st January 2024, which is given above. So 400,000 for ordinary share capital, 23,000 for share premium, 199,000 for retained earnings, and 622,000 for the total. So 400,000, then 23,000, 199,000, and 622,000. Okay. The very first transaction was of the final dividend of 70,000. Let's write it down. So this is 2023 final dividend. Dividend will always be paid out of the retained earnings. So we need to subtract 70,000 from the retained earnings. Okay. Then the second transaction was our bonus issue. So for bonus issue, the total value was of 40,000. So this should be recorded within our ordinary share capital. Then we need to subtract 23,000 from the share premium and 17,000 from the retained earnings. Let's write it down. This is for bonus issue. We issued a total value of 40,000, out of which 23,000 is being funded by the share premium and 17,000 is being funded by the retained earnings. And always remember, for bonus issue, the total will be 0. Then for the next one, we have information related to finance costs. We do not record that within our statement of changes in equity. Then we have the interim dividend with a total of 35,200. Let's write it down. So this is 2024 interim dividend. Again, dividend will be paid out of the retained earnings. So 35,200. Then we have our profit for the year. Profit for the year will always be added to the retained earnings. So we need to add 180,400. This is profit for the year. All right, that will be all. Then we can figure out our balance at the closing date. So balance at 31st December 2024. Okay, for ordinary shares, that will be 400,000 plus 40,000, which results in 440,000. For share premium, that will be 23,000 minus 23,000, which will be 0. For retained earnings, it will be 199,000 minus 70,000 minus 17,000 minus 35,200 plus 180,400, which results in 257,200. And for the total, that will be 622,000 minus 70,000 minus 35,200 plus 180,400, which results in 697,200. That is all for the first part. Let's move towards the next one. We need to calculate to 2 decimal places the return on capital employed for the year 2024. So the return on capital employed will just be our profit from operations divided by the capital employed. And capital employed will just be our equity plus non-current liabilities times 100, because we need to show the answer in percentage. Now, while calculating profit from operations, we need to use our finance cost, because if you remember the format for statement of profit or loss, it will be profit from operation minus finance cost, which will be equal to profit for the year. So profit from operations minus the finance cost of 36,000 will be equal to profit for the year of 180,400, which means that profit from operations will be equal to 180,400 plus 36,000, which results in 216,400. Let's write it down. Then capital employed is just equity plus non-current liability. The total equity, we have it right here. We need to use our closing balance because this is for the year 2024. So 697,200. Then we have two different non-current liabilities. We have two different debenture. One is of 300,000 and the other is of 400,000. So that will be 300,000 plus 400,000 times 100. And we need this value to two decimal places, and this will result in the value of 15.49%. That's all for the second part. Let's move towards the next one. Now, we need to calculate to two decimal places the gearing ratio for both the years 2023 and 2024. Okay, so for the year 2023, remember that gearing ratio will just be non-current liabilities divided by equity plus non-current liability times 100 because we need to show it in terms of percentage. So for the year 2023, we only had one debenture because this new debenture of 400,000 was issued in the year 2024. So the only non-current liability was 300,000, and our equity for 2023, the closing date, will be equivalent to the value at the opening date of 2024. So the equity value will be 622,000. Let's write it down. So we have 300,000 non-current liabilities, then 622,000 equity, and 300,000 non-current liability times 100. This results in the value of 32.54%. Then for the year 2024, we have two different non-current liabilities. These two, 300,000 and 400,000. Then the equity for the year 2024, that was 697,200. Then again, the non-current liabilities, 300,000 plus 400,000 times 100. This will result in the value of 50.10%. Now for the next one, we need to comment on the gearing ratio with reference to the calculations in CI. Alright, so for gearing ratio, if it is less than 50%, we say that the company is less risky because in gearing ratio, we're basically seeing how much of our total investment, including both the permanent investment and the temporary investment, what percent of it belongs to the temporary value. And we need the temporary investment to be lower because we need to have enough equity to cover our non-current liabilities in the future. And for the year 2023, only 32.54% belong to the temporary investment. It means that we have more than enough permanent capital in order to repay it back in the future. But if you take a look at the year 2024, it is 50.10, which means that more than 50% of our investment belongs to temporary investment. So in the future, we may not have enough permanent investment in order to cover this value, which makes our company more risky. So we just need to explain that. Let's write it down. This is of 4 marks, so we need to have 4 different comments. So let's start with 2023. So in 2023, 32.54% of capital employed was provided in the form of a long-term loan, which was the debenture, rather than from shareholders. And the company is regarded as low geared or having a low gearing because the value is less than 50%. Okay, now for the second one, this ratio increased to the new value was 50.10, which is in excess of 50%, which is regarded as high geared because it's more than 50%. Then a high geared company is always perceived as high risk company. Let's write it down. a high geared company is perceived as more risky than a low geared company. And in this case, the first debenture was issued in the year 2022 and the second debenture was issued in the year 2024. Right now, we have 50.1% of gearing. So our company, TNPLC, may have difficulty to borrow further funds in the future. Let's write it down. TNPLC may have difficulty to borrow further funds in the future because the company is already high geared. That's all for the third part. Let's move towards the next one. We have some additional information. The 2023 interim dividend was 0.05 per share. TNPLC had a dividend cover of 1.8 times in 2023. In considering the proposed 2024 final dividend, the directors suggest that the dividend cover for 2024 should be increased to 2 times. We need to calculate the proposed 2024 final dividend per share. Okay, so we just need to use the formula for our dividend cover. So dividend cover should be equal to 2 times. And dividend cover will just be our profit for the year divided by the total dividend for the year. We already have our profit for the year, which was 180,400. Let's write it down. So 180,400 divided by the total dividend. So the total dividend should just be 180,400 divided by 2, which results in the value of 90,200. And this is the total dividend for the year 2024, which includes the interim dividend as well as the final dividend. We already have the information regarding our interim dividend, which was 35,200. So we just need to figure out the final dividend. So 90,200 is the sum of interim and the final dividend, out of which 35,200 was the interim dividend. We need to figure out the final dividend. So our final dividend will be 90,200 minus 35,200, which results in 55,000. Okay, and in this case, the total number of shares that we have, the total value is 440,000 and the total number of shares we have at the closing date is 220,000. So we need the proposed dividend per share. Now the proposed 2024 final dividend per share, we just need to divide the total value by the number of shares. So 55,000 divided by 220,000. This results in a value of 0.25. Okay, now we need to explain why the directors want to increase the dividend cover for 2024, because in the last year, the dividend cover was of 1.8 times. So dividend cover basically takes a look at how many times our profit for the year can cover our dividend value. And increasing it means that we are only giving out a lower portion of the total profit as part of the dividend, which means that we are reinvesting more profit into the business. And this might be for business expansion. Let's write it down. To increase dividend cover, means that the directors wish to reinvest more profit into the business that will lead to business expansion. And since it will lead to business expansion, it will also lead towards an increase in profit in the future. So, and a further increase in profit in the future. Now, since we are investing more profit back into the business, it means that we will have a higher level of reserve because our retained earnings will increase by a higher amount. And the directors might want to make sure that the company will be able to maintain the current level of dividend in the future as well. Because let's say in a certain year, the business does not make a profit. In that year as well, the business needs to have enough reserve to provide the same level of dividend in order to keep the shareholders motivated to invest in our business. Let's write it down. The directors want to be sure that the company will be able to maintain current level of dividend in the future if profit falls. All right, that is all for the fourth part. Let's move towards the next one. We have been given some additional information. The market price of one share of TN PLC at 31st December was as follows in the year 2024 as well as 2023. Comment on the company's 2024 price earning ratio as compared to the company's PE ratio in 2023. We need to support our answer with calculations. So the very first thing we need to do is figure out the price earnings ratio. So price earnings ratio, we want to calculate it for 2023 as well as 2024. Now, price earnings ratio, the formula is pretty simple. It is just the market price per share divided by the earnings per share. Market price per share is given right here. So we first need to figure out the earnings per share for the year 2023 as well as 2024. The earnings per share will just be our profit for the year divided by the number of ordinary shares. All right, so for 2023, okay, we only have profit for the year for 2024, but we have the dividend cover of 1.8 times in 2023, and we have the interim dividend as well. Okay, this might be a bit tricky, but we can do it using the formula of dividend cover. So dividend cover is 1.8. This will just be equal to profit for the year divided by the total dividend for the year 2023. And in the year 2023, if we take a look above, we initially only had 200,000 ordinary shares, and the 2023 final dividend was 0.35. Interim dividend information is given below. The interim dividend was 0.05. So we have 0.05 plus 0.35. We give it out to 200,000 ordinary shares. So times 200,000. Now profit for the year for 2023 will just be 1.8 times 0.05 plus 0.35 times 200,000. This results in the value of 144,000. Now earnings per share will just be profit for the year divided by number of ordinary shares. So profit for the year is 144,000. Number of ordinary shares is 200,000 for the year 2023. This results in the value of 0.72. So this is our earnings per share. Now for 2024, we made bonus issue. So the total number of shares was 220,000 and our profit for the year was 180,400. So our earnings per share will just be 180,400 divided by 220,000. This results in the value of 0.82. Okay, so now the price earnings ratio for 2023 will just be the market price per share, which is 3.72, divided by the earnings per share, which is 0.72. This results in the value of 5.17. Now for the year 2024, that will be 4.65 divided by the earnings per share of 0.82. This results in the value of 5.67. We need to comment on the company's price earnings ratio, okay? This is of 5 marks. We've done 2 calculations, so that will be for 2 marks. Now we need 3 more comments. Okay, so price earnings ratio, we want it to be as high as possible because the higher price earnings ratio shows a higher confidence of the investor in the company's ability to gain profit in the future. In this case, it has improved in the year 2024. Let's write it down. Price earnings ratio of 2024 is better than 2023. Like I said before, a higher ratio represents a higher confidence of investors. Let's write it down. This suggests that the investors are confident in the future growth of the business. Now, in order to get a better overview, TNPLC should also compare its price earnings ratio with the industry's price earning ratio. Let's write it down. TNPLC should also compare its PE ratio with the industry's PE ratio. Alright, that is all for the fifth part as well as this entire question. If you found this video useful, make sure that you like the video and leave a comment below. And make sure that you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.